100,000 issued. Does that make sense? So, preferred stock, common stock, you're usually always going to see those. There are different types of stock. Preferred stock usually has priority in liquidations and for dividends, but you have much less growth potential. Common stock, that's what you're going to be normally buying on the market, and that gives you much more potential to grow, but isn't guaranteed a dividend. Then you have additional paid-in capital. That's if somebody pays more money for a stock when it's issued in excess of par. And then finally, you have retained earnings. Retained earnings, very simply, is what the company has accumulated out of its net income that it hasn't paid out in dividends. So when a company makes money, they pay their taxes, interest, cost of goods sold, all that BS. What's left over is the net income. That is the final profit that the company has made. That net income gets closed out every year onto the balance sheet as retained earnings. And it's not an account where cash sits, but it is the company's owners' earnings that they are entitled to, but they aren't necessarily paid out. So from the retained earnings account, the company can either keep the profits they've made inside the company and reinvest those in other projects, or they can distribute that or part of that as a dividend. The retained earnings account is where dividends come from. All right? But just keep in mind that a dividend is just taking money from your assets and paying it out and reducing your retained earnings. So the company's not actually creating free money. It's using its assets and it's reducing its assets and its equity to pay out a dividend. So it doesn't actually increase the value of the company. Okay? So that's the summary of the balance sheet. The key points, it's a snapshot in time. So if you were to look at any company on one day, that is what the company has on that day. Usually the company's balance sheet will be at the end of their fiscal year. But, sometimes they have quarterly balance sheets, yada, yada, yada. But generally the annual balance sheets are the ones that are audited by external public accounting auditing firms, and they're given the stamp of approval. Also keep in mind, audit reports are not a guarantee that these financial statements are accurate. The auditors make a reasonable assumption, or they give you a reasonable assurance that the financial statements conform to generally accepted accounting principles. But the managers who actually make the balance sheet and the other statements, they can do some trickery and even fool the auditors. So you need to be really careful when you're reading these statements and actually go into the footnotes and kind of see why the company is, or how they calculate some of their allowance accounts. Because the company management has some discretion in how they present these accounts. And they may be able to manipulate some of these accounts to make them seem better than they are. So there's a lot that goes into analyzing balance sheets. And I'm no expert, even though I know a lot about it. It's a lot of stuff. So you need to be really confident in understanding accounting and how balance sheets are constructed and who looks at them and what you can use them for before you even consider buying a stock. Which leads me to my final point. Buy freaking index funds, okay? You're not going to be able to understand this unless you're a freaking accountant and you know a lot. And be able to do the comparative analysis to make a really good decision on whether you want to buy a company based on its balance sheet, because there is a lot that goes into this and a lot of disclosures and information. So be very careful if you buy individual stocks. Don't use more than 5% of your portfolio and invest the rest in index funds, okay? I hope you enjoyed this video. Hit the like button, subscribe to my channel, and you have a wonderful day.